I'm Tim O'Hara, head of banking at Wells Fargo. At Wells Fargo, we have been extremely active in advising on and providing capital for the broader AI ecosystem. Today, we'd like to share some perspectives on the opportunities and challenges we see in this space. The conversation has evolved from initial high-level excitement about the incredible opportunities to an increasing focus on the unprecedented demand for resources and capital required to realize this technology's potential, and whether the capital investment required will generate sufficient returns for investors. To unpack all of this, I'm joined today by 4 colleagues who are having these discussions with clients every day. Welcome to all of you. Let's jump in. So just to set the foundation of the ecosystem, Sarah, can you talk us through what are some of the basic elements?
Sure. Well, data centers are the physical backbone that power AI. They provide the compute required to run models that do training and inference. In terms of what goes into the data centers, there's the chips that power the GPUs that are designed by the big name manufacturers. The semiconductors provide the raw materials like silicon to build the chips. And then these data centers require massive CapEx and power, largely provided by the cloud service providers. They run the AI stack, but they're complemented by the neoclouds that do the more advanced AI training. And then the LLMs come in to run their models, all for the benefit of the end consumer enterprises like Wells Fargo or consumers like us.
That's really helpful. Thanks for that, Sarah. I guess, Brian, you run technology, media, and telco at Wells Fargo. AI has been a big focus of the equity market this year. Can you just give us a little bit of equity market context on how much of the market is touched by AI?
You know, it's AI, but it's broader for TMT. You know, if you look at just changes and you look at where we are right now, TMT as a market cap percentage to the S&P 500 is over 50%. You take that back 10 years ago, it was 25%. What's really powered TMT is AI, the Mag 7, plus some others. So it's very prevalent. What happens in AI, what happens in data centers is impacting TMT, and it's really impacting the broader markets right now.
There's a lot of discussion about where we are with AI and how AI compares to some of the other big tech adoption cycles that we've seen. Where do you think we are?
We've seen now on consumer adoption through technology cycles, including AI, massive ramp. 1.8 billion users around the world are using this on the consumer side, but enterprises will move slower, faster than what we've seen in the past, but there's issues with legacy systems, data, security, privacy. So we'll see faster than past cycles, but there will be lags.
So Fadi, you focus a lot on infrastructure investors and infrastructure projects. All of this demand for AI capabilities is now driving and will drive more power demand, more demands on the power infrastructure. Can you talk a little bit about how that is going to play out with the existing capacity that we have?
Absolutely, Tim. I think the AI story is really a power story. Think about current AI power demand. We, like Wells Fargo, we projected currently at 8 gigawatts, going to potentially 90 in an unconstrained case. And if you think about what 1 gigawatt is, that's about 1 million homes powered. And so you think about it, we're building whole cities at a time of power demand. So we think our utility clients may have to spend about 1.1 trillion over the next few years to build some of this out. And that's gonna mean a lot of capital raised all across the capital markets. And at the end of the day, what a data center is a power delivery center. If you think about it, it's 4 walls that have a lot of power going through them. And that's really what the story is on the infrastructure side.
Thanks, Fadi. Those are some big numbers on power demand. I want to go to Rachel. And Rachel, you've been in and around this space for as long as there's been a space we've called data centers. Can you help contextualize it, though, in that what we think of as AI-enabled data centers today are pretty different from data centers of half a dozen years ago. So can you tell us a little bit more about that?
Yeah, absolutely. I think Fadi explained it well in terms of what the actual data center is. What's changed so drastically is the fact that you just need so much more compute for these AI data centers. And so what we're seeing is that back when we first started lending into the space, a big deal was a couple $100 million. It was 20, 30, 40 megawatts. Now we're seeing 500 megawatts, a gigawatt. So the scale to perform for these AI factories, you're just seeing so much more power needed, which is really creating challenges, opportunities on raising that capital, debt and equity, and then also where they're located.
Sarah, you've also operated around this space for some time. Let's expand a little bit on what Rachel was talking about. And can you help us quantify a bit of what you think those capital raising needs are likely to be in this space?
Well, the numbers are constantly changing and only moving up in one direction. The market consensus right now is that we'll need 5 to 7 trillion of CapEx by 2030. And what's extraordinary is we're not meeting the demand.
It's pretty amazing. I think just amongst the hyperscalers, some of the estimates we've seen are order of magnitudes 3.5 trillion or more just coming out of the hyperscalers alone over the next few years.
And I think what's interesting, Tim, you asked me earlier about the equity markets. There's not many pure plays when you think about AI. There's many large private companies. Certainly my colleagues, you guys see that on the private data center side. The hyperscalers have very diverse businesses. And if you look at where capital formation in AI has been, it's really in the private setting. VCs have really become the big investors. They've deployed big capital. So we talk a lot about AI, but it's hard for the public equity investor really to get their arms around these statistics.
So, Sarah, we've talked a little bit about the scale of the capital that is likely to be needed for all of this AI development. Help us with which are the different capital markets that are going to help provide all of this capital, and include banks in there too.
Well, I think with a 7 trillion need over the next 4 years, really all the pockets of capital are going to need to be tapped. That includes private markets and public markets. When it comes to the data centers, most of the build is happening in the private markets right now, but that could shift as we move through the development cycle. And then we're seeing a range of investors with different risk appetites participating. There are opportunities for core investors on some of the de-risked projects. And then we're seeing private equity who's more focused on opportunistic returns coming in to invest earlier in the cycle, maybe before a lease has been signed, that pre-development work. And then when it comes to the bank market, very active in these construction facilities, takeouts, and then the capital markets are playing their role for both development and for stabilized assets.
So let's just expand on the different products and different capital markets and talk maybe a little bit about what are the different financing approaches for those who are spending the CapEx that they're taking, and what are you seeing that's been particularly successful?
Well, it's really interesting. I think there's no one-size-fits-all approach. A lot of the cloud service providers have huge amounts of cash flow that come off of their businesses. So I think initially they were a little less focused on financing in the external markets. But as the scope of the CapEx has grown, they've gotten more creative. They've turned to the ABS market, high yield, CMBS. We're starting to see project bonds. I think even for those large cloud service providers, they're looking to all the markets.
That's great. So, Rachel, you know better than virtually anyone that a lot of the data center capacity in the US, about a third of it's in 3 states. Are those markets, California, Texas, Virginia, are they saturated? Are they capacity constrained?
Yeah, it's interesting. Back when we were lending, call it in 2018, 2019, it was really Ashburn heavy, the center of the universe. That's where everybody wanted to be. You started to see land prices go from $1 million an acre to $5 million an acre. So there was a lot of focus on these top tier markets. That's really changed. So I think it's a few things. First off, you're right, they're land constrained, and then really the power constraints. In Northern Virginia, our clients felt that really acutely. So they're going to where the power is. And I think that is just exacerbated by the scale of the AI factories that need so much more power and also land. So you just can't get that. So the interesting part is that from a real estate standpoint, never thought I'd be looking at projects in North Dakota or the middle of Wisconsin. And so it's really creating some interesting opportunities and really changing the way we think about markets. I was talking to one of the hyperscalers, And he was educating me on that. There's really just one US market now, and we should think about it that way. And so as we go into these markets, whether it's Central Texas or other further flung locations, it presents more opportunities, but also some challenges around workforce to build the data centers and also obviously to operate them.
So, Brian, everything from financial news to social media to the popular press is talking about where we are in AI as a markets matter, and are we in a bubble? Can you give us some perspective on how the focus on AI today compares with .com and some of the other prior moments of high enthusiasm for something new in the markets?
Yeah, no, look, it's something that we're not going to escape. People are going to be doing this comparison. I look at it on two aspects. First, valuation. Second, business application. On valuation, if you look at the S&P 500 right now on an NTM PE multiple, we're at 22.8. Yeah. If you take that at the .com peak, that was 26. If you look at the last 30-year average, it's 17.8. So we are at elevated levels. We're not going to escape it. It works if AI gives us a step function change in earnings. Then the multiple will compress and we're fine. If it doesn't, we will potentially see a pullback. On the business side, the huge difference right now is it's tangible. It's here, it's right now. In the .com era, it was a lot of concepts, it was a lot of ideas, but it wasn't a lot of revenues. Today in AI, there's revenue. It's not just proof of concept, there's real applications, companies are using it, they're getting benefits, and it's very tangible right now.
So I want to bring this side of the table back into it. Where do you, and Sarah, I'll start with you, where do you think are some of the better opportunities as we look at individual companies and instruments?
Yeah, well, I think this comes back to risk tolerance and types of investors and where they're playing. So, there's investors who are looking to really ride AI, that are investing in compute, LLMs, and they're taking a bit more risk, but there's a lot of upside. For investors that want to play it a bit safer, their mandate requires them to be more conservative, they're worried about a bubble, there's opportunities to invest in senior debt. For instance, we're seeing project bonds come that offer a nice pickup over the senior debt of where the operators trade, but still have the guarantees and the lease to back them up where they can feel secure about the investment.
Fadi, give us a little bit of an infrastructure investor perspective on that question. How are they thinking about the opportunities to invest in the space today?
I think, Tim, there's a lot of direct and indirect opportunities to invest. So obviously, some of the largest owners of data center developers are infrastructure funds, certainly. But also, if you think about what the tailwind has been, you've now seen a large amount of investment and a large amount of interest in independent power production, so the old thermal generation power producers. There's downward effects to pipelines. You see it play out in infrastructure services where you've got all of the electrical work that goes into a data center. And so it's a full ecosystem approach. And you do see a lot of really strong opportunities to invest. And sometimes you could be the fund building the data center, but maybe you want to be the fund providing the power to it, or even the gas that provides the power, so it's got a lot of knock-on effects to where you could be investing.
So, Brian, I'm going to come back to you. All of this capital raising and investment opportunity is generating a lot of capital markets and advisory activity. What are you seeing in your business in TMT with regard to the level of activity and the prospect for growth in that?
We really saw a pickup, I'd say, a year ago, and it just continues through the course of 25, and we're very optimistic when we look out to 26. TMT right now, if you think about its relevance in the M&A market, it's around a third. So it's sizable, it's material, but coming into the end of 25, the market for volume in US M&A was up 34%. Technology exceeded that number. So the dialogue's active, private to public. What we're really watching is the equity markets. If you look at 25, there were 17 technology IPOs. That was a lot different than what we saw, which was very limited in 23 and 24. But that number should be in the 30s. It should be in the 40s. So we anticipate it should double. But if you look at the number of private unicorns across the United States, it's a staggering big number. So There should be more IPOs, market should open, they'll fuel dialogue, and they'll blend into the M&A environment. So we think it'll be very active in 2026.
One of the big questions around AI investment is where is the profit going to be? Where are the investment returns going to come from that justify all of the capital investment? So maybe let's just talk for a minute about views on what are the smart bets at this moment where it looks like those are the things where we can have some conviction about the level of profit that they're going to generate. Sarah, do you have a perspective on that?
I think the end consumers that are purchasing the AI and integrating it effectively within their organization are going to have huge competitive advantages over the laggards that aren't using the AI stack to drive innovation in their business.
I think what's interesting is on the credit side, but really when you can think about the debt, whether it's bank or private credit, when you can get 100 bips plus premium to where that hyperscaler, which is typically investment grade, where their corporate debt is trading at, to me, that seems like a pretty, well, albeit the upside is capped, I think a pretty interesting and smart bet.
And I think ultimately, when you think about smart bets, we got to step back. Who's purchasing AI? It's expected to grow 30% CAGR in the next 10 years. Spend is going to go from 2% of overall IT spend to 15%. So the bet, it's very clear, companies across the GDP are going to use this to save costs. So there's efficiency. The real question on companies' minds are where's the ROI to generate new revenues, because it's a lot of money and there's a lag between results. So smart bet, for sure, the cost savings. The harder question is the revenue optimizations.
So does anybody's perspective change with time horizon?
For sure. You know, I think we're really watching this quarter by quarter. A lot of other technology innovation, you could track year by year. So costs, you're going to see companies every quarter reporting it on their earnings statements. Revenue, when there's actual proof points, they'll start talking about it and that'll spur others to act. So I think this is going to be fast paced, but by this time next year, you're going to see a lot of change and you're going to see it as a very dynamic market.
I think the whole time horizon question really plays into to whether an investment's appropriate for the public or the private market. A lot of these developers have been taken private because the time horizon to build out the infrastructure and realize your return is so long.
And ultimately, it's a newer technology. So as these companies get more mature, they tend to be better rated. They tend to have much more in the way of revenue. They tend to have much more in the way of EBITDA, which means that it makes even more sense to build out the infrastructure for the assets, and it's a self-fulfilling in that sense.
One of the great things with Wells Fargo is we are uniquely positioned to be able to provide solutions for the capital raising and advice in AI. And as all of you are well aware, we set up recently our Digital Infrastructure Solutions Council. A couple of you are the leaders of it. Rachel, can you give us some perspective on that?
Yeah, so more than ever, in order to be successful for our clients and to connect all the dots, you can't have silos, right? So I'm talking to the tech bankers that are on Brian's team, Fadi, our power, energy and power bankers, really across the board, we have to be really connected because it spans so much of kind of, whether it's real estate, technology, everything. And it's the same thing on the financing side, right? It used to be bank loans, and then it was ABS and CMBS and high yield and project bonds. So it's really been fun in the sense that you really are learning so much, collaborating across the teams to provide the best solutions for our clients.
Well, as you say, it used to be bank loans, and now it's banks and it's lots of capital markets investors. So maybe Sarah, can you talk a little bit about the range of investors that are getting involved in some of these different solutions?
Yeah, no, I mean, it's exciting because we really get to leverage the whole organization in terms of who touches what investor base. We talked a little bit about public and private, and then fixed income and equity, but it's insurance money, it's traditional fixed income investors. Really, everybody has a role to play. And the investors are working together too. We'll talk to banks who want to invest in a certain part of a loan, but they'll say, I don't want to do the riskier part, go to private credit, and we'll work together and create a holistic solution for the client.
And we haven't even talked about all the people that are touched by this, at least one concentric circle outside, right? So if you think about our TMT business, our IT services bankers have to be attuned to this. The security software bankers have to be attuned to this. Even, when I talk to our partners in our healthcare investment banking, industrials, it's really spanning the entire economy. And there's not many parts of innovation that this quickly touch all companies across the US and our economy and the world. At the end of the day, what's really exciting is the work we do with our clients. You three, Fadi, Sarah, Rachel, you work very closely together with our clients at Wells Fargo. What are some things that you really see the power of our firm and interactions together?
Yeah, I think as someone who has been with the firm for a really long time, I think it really translates to great execution for clients when the team that's working for the clients has worked together well, and we generally have a very collaborative culture. So the fact that we need to pull in so many different areas of the bank, of the corporate investment bank, it really lends itself to the culture that we have at Wells, which is very collegial, hardworking, but we don't take ourselves seriously, just the work, and we genuinely really like each other.
I think, too, the clients really like the interdisciplinary approach. We have data center developer clients who want to hear from my technology colleague. They want to hear from my colleague that covers the independent power producers, get that lens. It's never been as important to the business as it is now to bring those different perspectives.
Yeah, what I see where we are right now, 26 and beyond, is going to be dynamic. It's going to be fast paced. You got to be nimble within our teams to really deliver for clients and meet their expectations.
I think we've got lots of proof points about how we, Wells Fargo, can bring solutions to our clients who demand the capital and our clients who have the capital to invest. We've just recently demonstrated our own capital strength with the financing that we just provided for the single largest commitment a bank has ever given to support an acquisition financing. We've been the fastest growing investment banking franchise in the market over the last 3 years. And that was recognized as well with the award we just got recently for being the IFR International Financing Review Bank of the Year. So let's end on a high note. I think we've all heard leaders in the AI space talk about how the potential of the technology, it may be the greatest of any technological revolution that we've seen since the industrial age began. So what are some of the things that all of you are excited about that you see as some of the possibilities of AI?
Yeah, I'll start with something that hits close to home in education. When you think about the opportunity set to really democratize access to great education for all different types of learning. Your kid's having trouble with geometry, it'll think about what are the proofs it needs to work on. So I think that's super exciting.
Okay, so no surprise, my colleague Rachel took my answer, but let me build on it. At the end of the day, what excites me, beyond just being a technology banker and the actual models, it's what does it mean through K through 12? Then when people go to college, and then in the workforce, because at the end of the day, you want people to be curious. You want them to be curious and play around with these technologies. The best place to start is when it starts in education. So if the kids get educated, they go to college, they learn the application, they come into the workforce, and you don't have to start them off with the basics. People at early ages will have a sense of the technology, and then it'll just have rapid adoption through the enterprise.
I'm really excited about some of the early indications of how AI can help advance healthcare improvements, whether it's diagnostic, reading MRIs, X-rays, being able to catch nuances that a human eye might miss, but then also drug development, really being able to use deep AI models to do research, training, find new solutions, and modify drugs. It's really exciting potential.
I'm excited about the unknown. There's so much money being invested that to some extent it's creating the need for, innovation of the future. And we don't know what that's going to turn into. It could be something completely life-changing. Nobody knew what the internet was going to do when it started. And so this is kind of that moment.
That is such a Fadi answer, by the way. Yeah. He's most excited about the unknown. I love that.
Yeah, and at the end of the day, as we talked about, there's so many private companies. Just imagine what it's going to be like if and when they go public. How much opportunity there'll be for the investor to not just invest in infrastructure in a private setting, but to do it in a public context.
Well, thank you for all of those perspectives. It's really been great and a lot of fun to do this with all of you. And thank you to all of you for watching.